Hello, and good afternoon. My name is Juan, and one of the founders of Darwinx. Unfortunately, as you can tell, my voice today is not at its best shape, so I apologize for the quality of sound, and I hope it's not too raw by the end of this. Um, welcome to this webinar where we will discuss some of the obvious and slightly less obvious things that drive independent traders into a mousetrap. And I sincerely hope that watching this will help you not follow the what I call the trader cemetery, which is where ultimately, the numbers are unknown, but it could be 95% of independent traders who start trading today will have pretty much abandoned and or lost everything reasonably shortly. And unfortunately, a lot of people question me when I mention that number, whether it's just like a made up number, but you can actually verify those numbers with some of the big brokers. And I'm not saying that plus 500 on which these numbers are based is better or worse than your average broker dealer. But as you can see here, these are public financial statements numbers from plus 500, and in them you can see a few interesting figures. So, for instance, you can see that at the end in the last quarter of 2013, plus 500 had 50,000 active customers, which is give or take about the same number as they did have the last quarter of 2014. And the mind-boggling or very sad reality of that number is that they also had 20,000 new people starting in each of those two quarters, which basically means, if you do some very basic demographic analysis, that the average lifespan of an average plus 500 customer is the 2.5 months that results from dividing 50,000 by 20,000. So, it could be 90, it could be 85, it could be 95%, but the fact is there's a lot of people losing a lot of money. And but there's a lot of flawed conclusions being drawn from that fact. So a lot of people focus on the symptoms of that happening, which is, for instance, the fact that people take way too much risk, but they're failing to look at the root causes why that happens. So I really do hope that today we can look at those in the right sequence. And really, it is a sequence where one bad step leads to the next. So to answer the question, are so-called retail traders fundamentally inferior chimpanzees who don't really know what the heck they're doing? And the answer to that is absolutely not. I don't know how much you know about Darwinx, but one of the things we have done for quite some time is analyze upwards of 10,000 trading accounts of independent traders. And one of the surprising insights that we derive from that is there's a whole lot of money who has a whole lot of people who have come up with great strategies, and they're managing to lose money on those great strategies for doing some mistakes that could easily be avoided. So, even if you're losing now, don't give up on yourself, because it could be that there's nothing fundamentally wrong with your trading abilities, and it's just a few things that will make the whole difference from losing consistently to making money consistently. And as I said, it's really the most important thing to avoid is to not start down the wrong path, because if you do start down the wrong path, the chances are that you will end up in the wrong end, and that's what we don't want. So let's start with the 10 reasons that drive independent traders into the cemetery. And the first one is, very, very, very obvious one, and it's actually trading to get rich quick. So trading is a lot of things, but it's really not a get-rich-quick way to being a millionaire. Unfortunately, I really do hope that you already know that those things do not exist, because if they did, everybody would be a millionaire, and not everyone is. So if you haven't traded for a long time, you probably don't know yet, but here's the thing. It'll take you a long time and a lot of frustration to get to a point where you win consistently. And once you win consistently, it will not be 100% per month. It will be at best 2 to 3% if you're really good at it. So, you get out of life what you put into it. So make sure that don't really trade for the money, because if you don't really love what you're doing, you'll never put in the hours. And if you don't put in the hours, you'll never get to make any money out of it. It's as simple as that. It sounds like a stupid thing, not worth attending a webinar, but I just had to say it because it's really the first reason. If you don't meet this condition, loving your trading, then it's better that you go do something else and play the lottery, because the chances are you'll make more money doing that. And anyway, what's the point of spending your life doing something which is not worth it, right? So, with that out of the way, let's go for more substantial stuff. The second trap, and this one is almost as obvious as the first one, it's really about the business model. So if you think of what you're doing as a trader, well, you really hope to have developed some investable skill that allows you to leverage whatever capital you can put to work to produce the returns that allow you to kind of pay your mortgage and pay your kids' school and whatever it is that you fancy paying for. This is the core reason why most independent traders fail is not that they lack the investable ability, is that they lack the leverage to generate the absolute returns they need. So if you're making 20% a year, every year, then you are an amazing guy. The problem, of course, is if you start with 3,000 euros, then there's no way that the 600 bucks you make in your first year is ever going to pay for all the expenses you have. So a lot of people draw the wrong conclusion for that, and basically they try to achieve what are impossible returns. So there's the kind of guys who go around claiming in forums, I can make 30% a month and what have you, all these kind of silly claims that you go around and seeing. To do that, you'll have to incur in so much risk if you're only trading your own capital that the chances are you'll be dead by the second month, and as we've seen in before, and we'll see in a second. So the short answer to whether independent traders are stupid is it's not. They're not any more stupid than the guys at your average bank. In fact, you have a lot of pretty bad traders trading with banks, unless you didn't know that. The only issue is that they're playing a different game. They're playing the game for kind of making 0.5% a month or 1% a month. And that means they don't need to take too much risk, which means they can survive when the Swiss franc moves by a lot of money or there's movements in the euro, as you have seen lately. Whereas if you leverage 300 to 1 and you get on the wrong side of a trade with that kind of leverage, then that's pretty much your last trade. So it's rather, you can't really compare the two games, and the fact that many people fail at achieving 1,000% per year consistently does not mean that they're good traders. It merely means they're trying to do something which is impossible, and they obviously fail at it. And then here's the next one. There's a very complex chain of incentives whereby brokers tell you a different story from what I just said, and they kind of promise this get rich quick, leverage yourself to the maximum and make a killing. That really doesn't end up well, and it doesn't for the following reason, which brings us to the third sin that kills many traders. So when you're trading with low leverage, the return of your strategy is as good as your average trade. Meaning that if you just had a bad trade and you've put in like 60 good trades before that, well, the last trade is neither here nor there because things average out over time. And the return that you're achieving is as good as your average trade. When you're trading with low risk, that is. If you choose to leverage yourself a lot, then you're going, of course, for maximizing the return on your capital, but you're paying a big price because as you leverage, you're amplifying both your wins and your losses, and really things become a lot more tilted towards the outcome of your last trade. It's kind of very simple, right? If you take 100 trades with the same risk, then you're as good as your 100 trades. If you take 100 trades with a risk of 1 and you take the last trade with a risk of 1,000, to take this to the absurd, then it's not a question of whether you're a skilled trader or not. All you are is if you won the last trade, you're a genius. And if you lost it, you're a loser, which is completely not what you are. It's just like a question of luck on how the last trade played out. So to prove and put more substance behind the stuff that I've been saying so far, which some of you guys could dismiss as just being plain old known bullshit, I'd just like to show you some facts that we have derived from all the studies we've done at DarwinX. And I shall mention that we will be mentioning some free tools available at the site. All you need to be able to benefit from those is to either open an account with our broker on MT4, or you can also link any live account with any other broker, and we'll diagnose that entirely for free. The linking process is exactly the same as you would have with MyFX Book. It takes about 5 minutes, if that. Okay. Also, I haven't really mentioned that I would welcome any questions that you want to pose on anything that I say going forward. So please feel free to put them into the chat, and I'll try to take those as we go along, either then and there, or I'll just ask you for a bit of patience when that happens. Okay. So, we've talked about the risky stuff. So let's go see what happens when you trade with a lot of risk. So what you've got here is a list of strategies that people have put up for us to diagnose with our diagnostic algorithms, and we do a bunch of things with them. One of them is to diagnose how much the trader can lose the worst month every 20. So what I've done here is filter the 5,000 odd strategies that we have by the amount of monthly risk. And as you can see, my filter is on the red, crazily insane risk level. And what you can see here is the return that many of those guys have achieved. And as you can see, there aren't that many of those guys that are still alive. And I bet you anyone trading with that risk will eventually hit a bad trade and lose it all the way all these guys have. So if there's one thing you're going to take away from this webinar is just don't trade with crazy risk, because it's just not worth it. And it's not even necessary anyways, because we'll get into that, but it's really not necessary to make a living from trading. You don't need to make 1,000%. That's not what it's about. Right. So, by the way, if you have a question of how much your own personal risk is, and you're wondering, how much could I lose trading the way I do? Well, wait no longer. Just sign up, and we'll let you know the monthly loss that you will exceed the worst month every 20. And that way you actually know if you're a high risk trader or low risk trader, anchored on facts, not just like subjective assessment. And as we saw, it's really not a good idea to have too much high risk, as I just was discussing. So the next one, and this one starts to be, we're moving away from the very, very obvious one to the more hidden psychological stuff here. So there's a question of what was covered so far. Well, I'm afraid I think this webinar is going to be recorded, so you can watch everything we've been saying up to now. But there's another 50 odd guys attending the webinar, and it would not be too nice to them. So apologies for that, Mr. C. Okay, so the fourth of these sins is a psychological bias that every human being has. So if you think you're not part of it, then you're wrong. Every human person is subject to loss aversion. And I'll explain in a second what it is, and then I'll explain in a second why it is. So loss aversion is a human bias that kicks in when we are under pressure or stress. Translated to trading, what this is when you are in a trade with a lot of leverage and you are quite nervous because of that leverage, and you are winning on that trade, then your reptile brain is going to tell you, hey, you're up, lock in that profit, close that trade now, and keep the profit for as long as it lasts. And that's what you do. You basically you've seen you're up, it's good money, you close the trade to lock in the profits. Conversely, when you're losing, then of course your reptile brain tells you, shoot, you're losing at killing right now. If you close the trade, then that loss is locked and it's going to be very painful. So let's just hang on and hope it gets better. Don't close it just yet. Now, doing that is the exact recipe to guaranteed losses. Because what happens is when you are up, the tendency will be to close the trade before the trade going in your favor has played out, which means you will miss out on more profits than you would have made. And similarly, when you are down, you'll hang on to loser until all the way down until you're margined out, by which point the decision is not yours anymore. It's actually the brokers that shuts you down. And in that situation, you become a trader that is worse than random. So the worst a monkey would do in trading would be to win or lose randomly, which is, okay, it's not good, but it's not guaranteed bad either, right? It's just random. Whereas if you are subject to loss aversion, then heads markets, the market wins, you lose, and tails, you lose. And that's because you're powered by your emotion. And again, we come back to the sequence of events we were saying, because you're working on the wrong business model, and you don't have invested capital, you're forced to take on too much risk. Because you're taking too much risk, you're pulling in your pants when you're taking your trades. And because you're pulling in your pants, your strategy is becoming a systematic loser. Okay? Now, do you want to know if you are a systematic loser? Well, it's a very simple thing to figure out. And we offer this diagnostic to you guys in the discipline grade we provide to all our users. The way this works is, what you've got in this chart is a sequence of all the trades taken by a strategy. And if you look at each of these bars, a green bar, so what we're looking here is the favorable and adverse excursion of your trades within your trades. In other words, if you open a trade and it goes up to 2% within the lifetime of that trade, your maximum favorable excursion would be 2% of your equity. And if it goes down as much as 3% of your equity before you close it out, then you will have an adverse excursion of 3%. If you are suffering from loss aversion, then the size of the red bars, which is the maximum loss you're willing to take, will be larger than the size of the green bars, which is the maximum profit you're still okay hanging on before closing. And if you see that the red is bigger than the green, it's a very, very strong sign that either, if you're an algorithmic trader, that your algorithm is badly calibrated. And if you are a manual trader, it basically means you're very likely taking too much risk and you're not acting rationally, and that's probably costing you a pretty penny. Any questions on this one? Right. Okay. So there's a few nice examples about this one that I'll just highlight now to get you guys to give you the intuition. So, for instance, if you are sitting in court and you have a chance of making positive damages. So, for instance, you have a 95% chance of being awarded £100 in damages, and obviously a 5% chance of not being awarded anything. And then I come to you guys and I offer, hey guys, I offer you 90 quid and let's forget about what the judge says. Obviously, what I'm doing is I'm offering you 90 for something which is really worth 95, right? Because the expectation of your money is 95% times 100 is 95. So I'm kind of, in a way, I'm stealing from you. So if you're acting rationally, then you'll tell me, hey, Juan, you're kind of trying to take $5 away from me. I'll just, wait for what the judge says because my chances are better if I wait. And that's because $100, okay, it's not something which will change our lives forever. So we still act rationally. Now let's think of the same situation, but instead of being awarded $100 in damages, we were going to be awarded $100 billion in damages. Okay, so let's face it now. So you guys have a 95% chance of winning 100 billion, and a 5% chance of winning bugger all. Like going home knowing that you could have won 100 billion, and because you were greedy, you just lost it all. So if in that situation I come and tell you guys, hey guys, I offer you 90 billion no matter what, in case you give up waiting for the judge, and very likely the answer is going to be different. You guys will tell me, hey, give me my 90 billion, and I go run. And of course, I know you're making a 5 billion profit out of that. But who the fuck cares, right? I've got 90 billion, my life is solved. So there you go. I mean, if you answered no to the first proposition and you answered yes to the second proposition, which a machine would have not done, a machine would have said no to both cases, then you are a loss-averse human being, and this could happen to you if you take too much risk. Okay. And by the way, you can get your diagnosis for this, of course, for free, as I was mentioning before. So the next error is bad risk management. And please, please, please don't confuse trading with too much risk with bad risk management. They are two different things, okay? And I'll explain why. So what is bad risk management? Well, bad risk management is changing your risk across trades. You won 3 trades in a row, you feel like you're master of the universe, you decide to leverage up all the way because you're just, you're just so good. Why not do it and get rich quicker? So there you go, and you double the leverage. And then, of course, maybe it goes well, and then maybe the second time it doesn't go well, and you lose a bundle, and then you go, oh, I lost my last trade. I got to keep risk down. What percentage of risk is safe? Well, that really depends on, so there's an interesting question on this one, which is what percentage of risk is safe? Well, safe is different things to different people. I guess the best you can do is get the risk level that you're currently trading with. For instance, if we go a few slides back, you could go to, we can go here. So you can come to DarwinX and see that your risk level is, say, kind of between 35 and 70% a month. So you could be losing the way you trade between 35% and 70% a month. In that situation, if you're comfortable with that, then that's safe. If you're not comfortable with it, then it's not safe because you will be subject to loss aversion and you will do less well than you would do. So that question is really for you, not for me to answer. The important thing is that you know how much risk you have. And then once you have it, that you always trade with the same risk. That's what risk management is about. It's not the level, it's actually the fact that you always take the trades with the same level of risk. And I'll explain why. Changing risk across trades is a very, very, very stupid thing to be doing. And here's why. Now, it just could be that you have an underlying strategy, which is a piece of junk. It is guaranteed to lose money in the long run. It just so happens that you chose to take a couple of high leverage trades and you were just extremely lucky that those trades played out. And then your strategy seems to be making money, even though it's actually a crap strategy that just got lucky with high leverage for a couple of trades. Similarly, you could do the opposite error and get unlucky because you have a winning strategy, which is bound to make money on average in the long run. But because you're doing stupid things and changing risk across trades, then you get unlucky on a couple of trades and you seem to be losing money on your strategy, which is perfectly possible if you change trades by too much across over time. So in that situation, you would have been fooled by a mirage, and essentially you could continue on a junk strategy, which will lose you money in the long run, guaranteed, or even worse, you could have abandoned a winning strategy thinking that you're a loser, where actually you're a winner who just doesn't know how the fuck to manage risk, which is an even worse mistake to be making. Okay? So do not, whatever you do, always trade with the same risk. It's got to be a level that you feel comfortable with. Otherwise, you'll do plain silly things. It doesn't have to be high. So if you ask me what I think safe is, well, you can ask the best traders at DarwinX. And those guys rarely, if ever, take more than 5 or 10 to 1 leverage. Okay, so it's really as seemingly low as that. And even 10 to 1 leverage is a lot of leverage. Okay, so, if you change risk, as I said, it could just be a question of luck. And then in that case, you would be fooling yourself into deriving wrong conclusions. Now, the most important thing, of course, as I said, is to figure out whether you do change your risk over time. And as I'm saying here, if you want your risk management diagnosed, that's exactly what we do at DarwinX. Basically, we check the minimum and maximum risk you took in a given period. And if that's more or less constant, for instance, as in this case, we give you a very good grade because this guy, whatever he does, he will not be fooled by randomness. If this guy is making money, it's because the strategy is good, because he's always risking the same thing. If his risk was all over the place, the way most traders are, then, as I said, there's no way to know whether your strategy is good or bad, because it's really down to how lucky you were in your high leverage trades. Okay, questions on this one? Okay, just to summarize, high or low, do whatever you want, but hang on to it. Right, the next one is not entirely traders' fault, but it's actually, but partially it is, and that's what I call believing in Mickey Mouse. So, I go around and you can see there's 55 million blogs with some guy who has come up with a Teenage Mutant Turtle strategy that makes money every month, no matter what. Obviously, that's a whole boatload of bullshit, and the only way to kind of stay away and clear from falling into those traps is to use your healthy common sense. And that is to say, really, if you be honest to yourself, if you really had come up with a consistently winning strategy, which wins in all conditions, you have basically invented a money multiplying machine. And if you have invented a money multiplying machine that is worth billions, because obviously if you have a talent for growing any money, then money will come to you. You can grow the money for a share in the profits, and you can become a billionaire even if you start from scratch. So do you really, 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 really think that if you had that, you would package it up as the Teenage Turtle strategy and sell it for 100 or 500 or $1,000? I really hope, I'm not taking the piss here, and I put the turtles in there because that's as ludicrous as many of those claims are. But please, please, please don't fall for any of that crap, okay? So on that, over time, I've kind of developed a filter for bullshit for what I called the meat grinding machine. Okay, so why do brokers give up to 400 to 1? The answer is very simple. So a true broker does not offer 400 to 1 because a true broker is trading with customers, not against customers. But a dealer, which is pretty much like a casino who keeps the losses of the losers, is very happy to offer 400 to 1 because they know exactly that if you are trading with 400 to 1 leverage, then you're going to poo in your pants. And if you're winning, you'll close your trades. And if you're losing, you'll hang on to your losers in a way such that you are guaranteed to lose. And since they're actually taking the opposite position of your trade, they will keep all your money and they will be very happy with it because then they can go and take your money and put some more advertising in all different sites, promising ways to get rich quick to attract a whole bunch of new idiots who leverage themselves at 400 to 1, lose their money, and feed the broker. That's why so-called brokers, who are actually dealers, offer 400 to 1 leverage. And as you can tell, I feel pretty strongly about this one. So on that note, ways to tell the money grinding machine are, for instance, when you have a teacher who offers his services for free, if only you trade with a certain broker, then, that's kind of a bit like a poker teacher being sponsored by a casino who wins against bad poker teachers. And how credible is that, right? Not much. So, and then on it goes. You have all these free courses to become a millionaire in a month type of thing. And also there's all these guys who run or allegedly run a hedge fund and then spend like 5 hours a day teaching on the side. All these guys who are millionaires and just kind of trade because for the fun of it, but they don't really publish why they're millionaires or what the track record is. And all these other guys who basically advertise like crazy to get new students. And the question is, if the students love themselves, how come they don't really refer him? Why does he need to resort to advertising? Because there's good money to be made make by attracting fresh meat into the grinder to keep your money. $12 you put into your deposit that you then trade with 400-to-1 leverage, and you lose, and the broker keeps it. Okay. Apparently it was just a joke, but I just wanted to make sure people understood this one, and apologies for being so repetitive. So on to the next one. The next one is, one of the things that happens and lose money on the broker. It's actually the wrong thing to be doing, because really who you trade with ultimately is your choice. So if you choose a bad broker and that broker goes down when the, say, Swiss franc does something, then it's easy to blame it on the broker, but really the fault is yours, especially if you chose a non-regulated broker, registered, so to say, who knows where, in some sort of island somewhere. So again, the more a broker advertises, the more you should distrust, because, you know, if the customers are making money, if a broker has I'll say it, if a broker has customers who make money, then the assets under management grow, which means the commissions grow, which means the broker does not need to spend so much money into advertising, because they've got a per se profitable business. It's only when your customers come in and lose that you need to replenish your customer stock by new customers. So again, a lot of advertising is not a good thing. It's actually a bad thing. It means the customers lose. So, okay. So a good question is, brokers offering very low spreads, right? That's actually a very good question. So it really depends. If the broker is a true broker who does not trade against customers, then low spreads are a good sign. Because they're essentially, you're paying low amounts in commissions, which means your strategy will be more profitable because it's losing less to the spread. Now, the other thing you could do, so really when you have people leveraging themselves 400-to-1, the spread is pretty much neither here nor there, because if you're going to lose guaranteed, then you could offer zero spreads. The people will be doing, if people still do something stupid, they'll still manage to lose on low spreads, and you'll still keep the money. So the spread, when you're trading with too much leverage, is neither here nor there, because what matters is actually whether you make money or lose money. Right, okay, there's a question. When we place a trade, does a broker also put a trade on? That's a very good question. So a true broker means a pure intermediary. A pure broker, like for instance Darwinex, which is 100% DMA, whenever you put on one lot of Eurodollar, we put on one lot of Eurodollar, so that we are protected from your P&L. Whether you win or lose does not really hit us in the short term, because we're neutral to the outcome of your trade. That's what a broker does. If we were a broker dealer, and 99% of so-called brokers are actually broker dealers, what they do is they monitor how well you trade. If they see that you're a headless chicken that's going to do something stupid, then what they do is they do not put the trade on. So you go long the Eurodollar, they go short the Eurodollar against you, but they're actually betting against you because they know they will keep your losses if they don't cover that. And I'll show you in a second how to tell who is a broker and who's a liar, okay? So Sandy, hang on for a couple of minutes and I'll answer that question. But even before that, you guys have just mentioned what the broker incentives are, and actually I've done a webinar which has proved quite popular in FX Street. You can search for Brokernomics, which is the economics and incentives of brokers. And I pretty much explain what drives the different broker types and how to tell one from the other. But the most important thing, even if it's a dealer, you want to go with a regulated dealer. So for instance, I do not trade with IG Markets. They are a market maker, but I would have no problem trading with them because I know they're not, even if they're not hedging the trades, they're not doing anything that's going to actively harm me. And if things really go bad, I know they have the capital and the balance sheet to be good for the money that I put into them, which which pretty much non-regulated brokers are bound not to have. Because if they have the money and they are honest, why are they not getting regulated in the first place? So when a broker such as Darwinx, when you put on a trade with a true broker, then yes, we are putting the same trade in your direction. That's what a broker does. A broker dealer does not always do that. It could be that they just do not put on any trade and just trade against you. And the way to tell that is to go to the regulatory site. I'm just going to look it up so you guys can find it. So you go for instance, FCA register search. You can search the directory of the Financial Conduct Authority, which is the world's most respected regulator and the one by which, for instance, Darwinx is regulated. You go search for it. You can search, you can just enter the firm reference number, which you can look up at the bottom of the regulated broker. For instance, in Darwinx, it's 586466. You look things up, and the important thing to go is look for the permissions of that broker. And the permission to operate as a broker is operating a regulated activity called dealing in investments as a principal. And if you see a limited license, which is a match principal broker license like we do, what this means is whenever, say, FX Boyki takes a trade along the euro-dollar, then a broker like Darwinx is forced to take the exact same trade with an independent third party, which basically means we're not dodging the traders. And if you do not see this restriction of limited license match principal broker, this means that the broker could not cover that trade. It could be that they do cover it, nothing stops them from doing so, but you do not have the guarantee that they're not doing that the way you do when you see this limited license match principal broker permission in the FCA site. Remember, this is the FCA, not our own site, so there's no way we're lying. They're not lying. They have no incentive to lie for us. So, Sandy, that's the way to protect yourselves against a low-level dealer or broker. Okay, then again, basically blaming it on the broker, it's a loser's excuse. It's your fault. If you choose a bad broker, it's your fault because you chose it, not the brokers or the dealers. Where did you get the reference number from? You can get it from the bottom of the page. So, for instance, if you look at the bottom of the page of Darwinx, you'll see is a domain owned by Tradeside Trading Tech, which is our company name, a company authorized and regulated by the Financial Conduct Authority with FRN 586466. Any regulated broker by the FCA has to have this at the foot of the web page. If they don't have it, they're not regulated. Okay. So, I wrote this thing with a list of the 10 sins not to do, and because the kind of 10 is sexier than other stuff, but literally that was it. I mean, I want you all guys to lift those spirits and end on a high note. Trading, if you really love it, it is possible if you persevere to actually make money from it. So just as I told you that most people don't make the money, if you don't fall for all these things and you love trading, then hang on in the game, and the longer you stay, and the more you force yourself, then the better you'll do. Darwinx website is www.darwinx.com. So risk capital how much capital do I recommend to risk? Well, first thing, if you have never traded before, then you should start trading a demo account until you figure out, how things more or less work. Once you've figured that out, then you should stop trading demo account and start trading live capital. We, for instance, keep the initial amount pretty low at $500, so that you can really start with $500 and trading micro lots, where you're really risking a euro up or down if you're trading without leverage, and that anyone can afford. So I would recommend to try and trade your capital like it was $1 billion, trying to grow that by, say, 20% a year. And once you are in a position to grow capital 20% a year, then you can bet that billions will come and want to invest with you, which is exactly what we do at DarwinX. So for instance, the way this works is you can essentially come to DarwinX, list your strategy, and then investors can buy it just like an asset or a stock. And when they buy your Darwin, so-called, what's happening is they are replicating whatever trades you're doing underneath, but we don't tell them what's going on, because that way, when they make money, we invoice them for 20% of their profits, and they then pay those to you, which is basically the business model that the professional guys are playing. We come back to this, and this is by far the most important slide we've discussed today. So if you're trading 1,000 euros or 500 euros and growing those by 20% a year, every year, then you can bet that eventually there will be 100 million euros replicating your Darwin. If you collect 20% success fee on 20% yearly profits, that's 4 million a year for trading a 1,000 euro account, and then you will be playing the professional game. So the important thing is to make positive amounts consistently. They don't have to be high. They don't have to be high, because it's easy enough to scale consistent returns, but you cannot scale them if you're risking everything on the last trade, because essentially you'll blow your money. So let's go back to the stuff, to the other stuff. And also, to prove that our mouth is where our talk is, we reward the traders who did the most investable stuff by trading with the highest levels, the best grades of experience, risk management, discipline, performance, timing, and scalability every month. And we pay out $4,000 cash every month to our best customers. And this is without bullshit or hidden conditions to it. This is cash that we pay out into your account, and you can do with it whatever you want. You can just pay your mortgage out of it if you want. Okay. So it pays in the short term, and once we launch the investor platform, which goes live tomorrow, then all you need to do is go trade with a regulated broker, enjoy the £50,000 capital guarantee by the Financial Services Compensation Scheme, meaning the British state, not a broker. We will never trade against you, as proven by the FCA, as I just discussed. You can check our spreads at MyFX book, and you'll see that they're pretty competitive. And in addition, so just for the price of trading with a cheaper broker than you're currently trading with, we will diagnose you. We will pay you if you do well out of the Darwinia challenge. And then you can also legally invoice investors for a 15% success fee, which de facto transforms you into a hedge fund manager right from home. So, that's all I had to convey today. There's nothing stopping you from living from your trading and getting a boatload. All you need to do is trade for the long run. So FXBlock, I guess you can check out the recording, or just get in touch with me. I can take that offline, because there's other guys waiting for this. So my only point is, if there's been anything which you found was insightful and that you would have loved that somebody told you ages ago, then I would be very, very grateful. And I think the people you recommend this to then will be better. Okay. So yes, you're asking what 8, 9, and 10 are. There's no 8, 9, and 10. There's only 7, but it was just sexier to talk about 10. So apologies for fooling you on that. It's a lot more simple than 10. It's if you do the right thing, you'll be fine. And that's pretty much it. So thank you guys so much for putting up with 45 minutes of a very raw voice. I hope this was useful. And if you have any questions, my personal email address is juan@darwinx.com. And once I get your emails, I will reach out with with a special proposition next week. I hope you like it. So, are there any more questions? Will I be able to do a follow-up? Okay. So I run about a monthly webinar on stuff. I never talk about trading. A, because I'm not a trader, and B, because if I was a trader and I talked about trading, I would be against my own rules. But I do talk about stuff like regulation or ways that you can optimize your strategy and so on. So, look out, and I would be very helpful, very pleased to do so. Also, if you guys have topics that you would like me to cover, again, feel free to email me at juan@darwinx.com, and I will take that on board and take it up with FX Street, see if they're up for it. So, thank you, FX Street, for making this venue available, and thank you all for attending this webinar. It's been my pleasure. Take care and happy trading, guys. Bye-bye.